None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everyone. A lot going on already. I think in the last 3 sessions now we've had well over triple-digit moves in the Dow Jones for sure, and we've seen just some crazy swings back and forth. You know, we saw a big rally or big sell-off on Thursday, followed by a rally back on Friday, mostly short covering. And then this morning we go back and retest those lows, actually print a lower low, and now we're down 403 on the session. So lots of volatility. Most of the activity, I guess, last night, there was a lot of folks running around the streets in Hong Kong. It wasn't Chinese New Year. Yeah, they had a lot going on. I'm not sure that was driving as much as people thought, because last night it was pretty moderate. The futures were down 5 or 6 points, and I think as the session got going, they use that in Europe as an excuse to do some selling. There's still a lot of stuff going on in Europe that nothing that looks good at this time. So that kind of carried into the markets. The DAX was down over 1%, and then I got our futures down. And of course, really what it's about, as I talked about in commentary this week, there's a lot of reports coming out. Some of them have already been out today that we'll talk about here shortly, but the big one is unemployment. We start off every month like this, and in the last several months it's not been that much to speak of. But this one's going to be interesting because we have the 142,000 number that's lingering out there last month. So do they revise that number up?
Right.
Does the front end number this time, the headline number, miss? They're looking at 215 in numbers, jobs to stay the same. I guess they don't expect anyone to leave the labor force, so they can't get it to go down. It's the only way it seems, the way the unemployment number actually goes down. I think the U6 number is still pushing around close to 12 anyway. I think it's 11.6 or something, just off the top of my head. Anyway, yeah, it's there's a lot going on from a volatility standpoint. I mentioned in commentary that the 3-day VPM indicator was up at 24.2. So far today, we've traded a 15.91 range. I suspect it's probably gotten a little tired off of this rally. The folks down in the trading pits and the traders probably have most of their fun. Probably see if they can push it back down. We'll go through the technicals here in a few minutes, but there's quite a bit going on, and we'll review this as well as the VPM saw quite a few more sells, mostly in mutual fund areas, and we'll go through the details of that. There didn't seem to be a lot of stocks, but our percent bullish continues to decline, and it's down to around 34 and change now. So my expectation, as I mentioned in commentary again, is for that to continue to decline. There's not a lot of reasons to own this market. There's a lot of reasons to trade it, but not a lot of reasons to own it at the moment. So we'll go on. And Mitch, we had a couple, 2 or 3 reports this morning, right?
Yeah, we had the pending home sales month-over-month change. Consensus was expecting it to be at 0.8%, came in at -1%, so that's a fairly substantial miss there. Consumer spending month-over-month came in at expectations of 0.5%. And then there was also a survey released, the Dallas Fed Manufacturing Survey. Consensus had it at 10.3. It came in at 10.8. So a slight beat on that one.
Guess what? That was the survey.
Survey, yep.
Yeah, so
just like we've talked about before.
Yeah, old story, folks. If it's a survey, it beats. If it's real, measurable numbers, it misses. And so I guess the people feel better about things than they really are. It's funny sometimes. The markets are worse than people feel worse than they really are. In this case, they feel better than they really are, and those are a continuous theme that's been going on for so long. It just seems it's probably been at least the last 6 weeks or more that we've been talking about this, and it continues to be the case. So let's go ahead and get started on the technicals this morning. I'm going to bring us in on the first screen. This is the 1 minute graph. It's a futures, and it's one of my trading tools that I use. And I'm going to just show you this rally over here on this screen. Let me bring this up full screen here. And you'll see the dip here this morning. This is also a 24-hour chart. The futures run pretty much 24 hours. I think there's 15 minutes. They don't trade in a 24-hour period. They shut the market down. But the bottom line is we're seeing this big rally here. It's probably rolled over a little bit. We get down through this low that I've got my cursor on right now, which is right at, let's see here. It is 1969.50, and we're trading 69.50. We're coming right through there. So we get through that number, we'll start to see some further declines. Going over to the daily graph here on the S&P 500, what we're seeing here is the market setting up potentially a minor bottom. After the retest this morning, we could see a couple days up here if the market continues to remain above the 1978.50, and that magical number is right around the 40-day moving average. I'll bring it up here on the screen real quick so you can see it. The 40-day is 1978.81, so it's right in that range. There's a Fibonacci number there at 1978.50. That's a key pivot area right in this zone. We're right about where we're trading below it right now. So Friday we saw the market rally back and close at 82 and change. It got back above that number, but as you can see, the activity today, most of the things that are going on in the marketplace is really just volatility based. And like I said, my expectations I discussed in commentary is that we're going to see a contraction of this volatility based on the 24.2 number that we see as the average, the 3-day average. We're already at 1591, and it's looking, like I said, probably like we've seen most of the range for the day. Looking at the weekly graph, we're seeing some continuation of the decline in momentum. And now the weekly graph doesn't have the same amount of noise. The daily is going to respond quicker to some of this volatility, but the weekly is where the PPM1 right now, let's see, I'm going to get off the screen just for a second here so we can take a look at these. But PPM1 over here on the left is 0. PPM2, 0.24, just below the trend level. And PPM3 is 17.91, so that's below trend level. So we are vulnerable to a point. Bringing up the numbers here, we're looking at the moving average numbers here are 1976 is the 10-week moving average, so that's once again right by that 1978.50 number. And then we've got a range down at 1961, which is the 21-week moving average, and then 1905.43, which is the 40-week moving average / 200-day moving average. And that is going to be the key pivot number. It's interesting that it all comes down to sometime in the next several weeks of challenging that number, if not sooner. This week is likely to be a huge volatility week. We certainly got plenty of things to look at. It's mostly housing some sentiment numbers, some of these numbers that are coming out that are off of the surveys. But the numbers for the most part we're going to be looking at is ADP on Wednesday, and then again we're going to be looking at the unemployment numbers. ADP is expecting 215, and it's about the same number on the forward expectations on the unemployment. The levels of interest, other than these bigger numbers, and when we start to break down the markets a little shorter, as we've got some key pivots. And it's interesting, we went right down to the support 3 number today. The number is 64.35. The low was 64.04. So we bounced off R3 today, and now we've seen. I'd be surprised, to be honest with you, if we got up to anywhere close to the 1988.60, which is the R1 number. That would be pretty amazing after the type of action we've seen, and we're already seeing some softness coming back into the markets right now. So the trend is 0 on a very short level, which is still suggesting on a short-term basis we still have some negative sentiment to deal with. On the intermediate basis, we are looking at the possibilities of a continuing decline down to below this 64 number. So there's a couple numbers here. If you look at the numbers that we put out on Monday, the S3 number today was 1964, and the S2 number on the weekly number was 1964.40. So we have a cluster again. I've talked about these clusters. These numbers and volatility range on the weekly and the daily are matching up a lot because they're so big at this 24.2 number. It really is causing these numbers on a weekly basis to be the dominant number. So below that is 1954.65 if we do get below these levels. My expectation is that with the numbers coming out on Wednesday, ADP and so forth, that's going to be the case. Now maybe some of this geopolitical risk, there's a lot of talk overseas last night. I guess people were talking about what's going on in Hong Kong and the significance of it all. It's a Tiananmen Square moment for the Chinese and how they deal with this, and it's interesting because this was kind of the aftermath of 1997 turnover. We saw some of this happen, and now they're trying it again. We're seeing it again, and for the most part, it's been interesting because China's let Hong Kong pretty much be Hong Kong. And now they're trying to get put their hooks into the economy there and start to take over and get the communists to be dominant there as far as the general thoughts on everything that's going on there. So as we go forward here, and let's look at the monthly graph, because this has been a big focus that I've been talking about over the last several weeks. And for me, this is the big kahuna. This is the big one, because what's happening here is we're seeing the PPM at 0.90 on the, let me bring these numbers up so you can see them. The PPM is on the 0.90 on PPM1, PPM2 is 0.151, so very strong, and 102 on PPM3. And as I've talked about, I'm expecting to see a convergence of these moving averages start to happen. And so the PPM1 says that the 10-month moving average is not moving as fast as the 21, so they're on a trajectory to meet. And when they meet and cross over, that will probably be the point where the market is trading toward the lows of whatever sequence that we're in at that point in time. Since this is a monthly graph, this is going to take multiple months to unfold. So we could see this coming in. This pattern could unfold as late as February and even as late as March. I guess March, February is going to be a window that is going to happen from a standpoint of the convergence. It doesn't from the price movement. We could see prices moving around both of these moving averages, which right now are 1762 is the number. I mentioned this in commentary as well. 1762, and there's another number down around 1740 that is big time support. And I will expect to see the markets ultimately reach there is they're really, while there's some upward momentum, it's not likely to cause any kind of substantial move higher. I have no idea yet. Until we see a close under 1905, I'll proclaim that the 2019.26 is the high of the market. But for right now, there's still, until we get a close under 1905, which is at 40-week. It's 40-week moving average. It's 200-day roughly, and it's also the key. It was last month's low, or in July's low was 1904 and change. So we get a close under that particular area, and it's going to signal from a technical standpoint a major high on the monthly graph. Until we see that, that's not the case. One of the things that did happen, and I mentioned early in the month when we started September, was it's typical that when you see a big reversal like when we in August, where we saw the market close at the highs of the month, so typically you'll see some follow through, and then you'll see the market close lower off of that number. And of course, that's been the case so far. It's a pretty easy call from the standpoint of how these bars fit together. And you can see over here where the last month closed at 2003.37. The high was 2005.04. This month we saw the 2019.26. So we saw a new high, and now we're trading way below that 03 number. We're at 75. It'll be somewhat of a, don't want to jinx it, but probably somewhat of a miracle to see this thing back above 2003 by the close tomorrow. So it looks like the month of September is going to be a lower close, which is pretty typical, and then that becomes a pivot bar as well. So the ranges are really well defined here from a technical standpoint. You got the 2019 high, and then you get that 1905 low. So that is going to be the battleground that's going to be laid out. And as I mentioned before, just looking at this monthly graph, the momentum that's in there still suggests there's a pretty substantial uptrend. You can see the 10-month moving average is 1903.98, so this is also right at that 1905 level. So this is going to be a big area to pay attention to as the markets unfold. Real quick, and I'm going to bring Mitch up here in a few minutes and have him go through the database. Last week I got way too windy on some of this stuff. I think we pretty much established what's going on with the trends here, and we're starting to see some softness come back into the market right now. But one of the things I just wanted to discuss pretty quickly here are twofold, actually, is I want to bring up the 10-year, which all of a sudden is all the way back at 248. And if you recall, we spiked up to 263. And let me get this on a daily graph here. This is an hourly. And you can see we rallied all the way up to the I think it was 264.20 level as the high. And now we've seen it move back into the 248 level, which is right on that. I mentioned the other day 252 to 248. This should be about where this thing holds right here. And I think once again, this differential in interest overseas is really keeping a good bid, plus the strong dollar. So you can make some pretty good money if you're sitting in Frankfurt buying U.S. bonds right now, and especially with the dollar continuing to appreciate. Take a quick look at the weekly trends on the interest rates, and what we're seeing here is pretty much a plus 21, minus 11, and minus 33. So we have this conflict where we have two of the moving averages in a downtrend, which is the 21 and 40. The longer periods are at those levels, and the short period is close to an uptrend. So this is pretty typical. It's the opposite of what I've been talking about on the monthly graphs from the stock market. What we are looking at is a convergence where that 10-period moving average is going to slice through the upside of these averages. Let me just bring up this so you can see it. The 10-period moving average is 2.646. The 21 21 as 2.509 and 2.601. So the 10 is rising, so it's going to chop through these, and these are the signs that there's trend changes happening as well. Even though we've seen things back up, that doesn't make for all clear skies for the markets moving forward from this point. So I think what I'm going to do now, bring Mitch back up here, and we'll chat a little bit about what's been going on in the database here. So I'll let you drive and hang, and let me just let me do one thing real quick before
Sure.
I give you control. Bring you back up on the screen, and off we go. Okay, it's all yours.
All right. So we had another week of selling, as we mentioned earlier. The database now sits at 34.19% invested, and what we have the ability to do on our end is to look and see, how that breaks down across the different spaces, whether it's mutual funds or stocks or ETFs. And in this case, if you actually look at just the stocks within the database, you'll see that it lines up pretty closely. We're long 34.68% of all stocks within the database. So even though this look right here is across the entire universe of all the different types of assets, we're finally seeing now is also the stock side coming to match that investment exposure as well. This week, though, when it came to the selling that we saw, we had a very large run of selling, another run in excess of 2,000 sells across the board. We had 2,440 different sells between the two trade systems. We only had 182 buys. So that brings the net change on the database to 2,258. So again, another large move across the database. What this did is this brought down our stock exposure. It brought it down another 3.68%. But what it also did is on the mutual fund side of things, it shaved off another 6.5% of investment exposure. So again, we're seeing this bearish outlook coming more and more when it comes to the database. So if we jump over to the actual dashboard here, we could take a look at where the real movement was within the database. And as you can see, it's pretty broad-based across the board when it comes to the sector side of things with stocks. The thing that jumped out to me, though, was the utilities. The fact that we had 11% of all the utilities that we track, we had selling. It wasn't but a couple weeks ago that we saw some buys take place within the utilities. So we're going to do some analysis this week to take a look and see what type of selling, if it was just a rotation within that sector, or if it was some weakness on some of those new trades that came around. But pretty much what we're seeing is this broad movement away from the market. We're just seeing additional protection being taken on. And as you skim through the groups here, you'll see that that it is broad-based, where we have some pretty heavy selling. But again, that concentration really is in the utility space at this point. Jumping over to the mutual fund side of things, this week we had a fairly substantial run on mutual funds, as I mentioned. Where most of this activity was, however, was in the allocation funds. So these are the time horizon type mutual funds, where we had 17% of all those funds went and were liquidated at the end of day today. We also had a fairly substantial selling in both the international commodities and the bond space. So, I mean, you can see that when it comes to the selling here, the weakness that we've seen consistently in the international markets has caused a lot of these trends to break down, and we're moving to more and more protection across the board in the international space. You can see here that the emerging markets took the largest hit this week, 37% exiting out of it. I know if you happen to listen to any of the talking heads on TV, on the financial networks, they were talking a lot about the emerging market space over the weekend and how they were hit hard, both at the end of last week as well as today. We're seeing some pretty substantial pullbacks in the EEM space and the components that make that up today. Further down, as I mentioned, allocation funds, pretty much we're seeing across the board selling. So this has to do, of course, with the amount of bonds and as well as the equity investment exposure that's finally getting whittled away in that blended asset. On the bond side of things, however, you can see that it wasn't just PIMCO that is seeing losses this week. We're seeing some pretty heavy selling in both the long-term bond as well as the multi-sector bond. That's really what's finally starting to move away from the heavier investment exposure that we have been seeing, and taking protection on that point. Aside from that, we'll just round it out here at the U.S. equity space. You see that we're skimming off some more of the holdings in the mid cap. That was probably the largest move back this week, moving out of that space. So again, the small cap, mid cap space has just been really hit hard. We're still seeing a fair amount of strength in the large cap markets as they've been able to endure all the pullbacks. If you happen to look at today's commentary, you would have seen, though, that the Russell 2000, we're now negative 3.5% on the year. So portfolios that have small and mid-cap positions as a heavy component to it are seeing that type of loss on the year, just because it's really just a large cap market at this point that's seeing the performance, and everything else across the board is just getting chipped away.
Yeah, hey Mitch, I just wanted to bring in a little perspective here. As far as the overall database goes at the 34% level, that is typically, I've talked about this in commentary, in most declines we'll get down to about 22 to 28% range. In the extremes of 2001 and 2 and in 2008 and early 09, and 09 was the most extreme, as you would expect. It got down to about 8% long is all. And so from a perspective of what the ranges are, I talked about the 42% as a tipping point. We went below that, we kind of came back to it, and now we're well below it at 34. So I expect the deterioration overall to continue. So what that means, what does that mean to your actual portfolios, is right now at 34%. So if you have 10 stocks in your portfolios, it really equates more to the individual stocks. I guess it breaks down better that way, is that you'll have somewhere between 3 to 5 stocks of those 10 long. So it pretty much goes across the database, that 33 to 45% range. So you're going to have 3 to 5 stocks long from that. So if you have 24 stocks, you probably have 6 or 8. You're probably at least 40 to 50% in cash at this time. There are some portfolios, and I have one of them, that is still about 78% invested. Just happen to pick some good stocks that, by the way, they're not really doing all that much. They just aren't going down. So a lot of times you'll see that kind of configuration happen, where you'll get a pretty good set of stocks, but they're not really making money. And I have seen other events and other cycles where you can see some positive formation of, you can actually make money. I always call them, you find some salmon that can swim upstream, and you can make some money on a portfolio from the standpoint of it being able to perform even though the overall market is flat to down. And in this case, we're seeing a lot of volatility. So, it's really not, this is, I think, a pretty typical decline in how these markets are unfolding from the standpoint of what a decline looks like normally. In 2000, and like I said, 2001 and 3, and also in 1998, we saw a pretty extreme move there as well, flashing way back in history, as we saw the percentage of bullish patterns in our system go down. And what it means when we say 34%, folks, is what that is that those are only 34% that are showing trending type characteristics. It doesn't even mean they're going up. It just means they're probably not going down. Some are doing well. There's always stocks that are going well. Deckers seems to be a gravity-defying stock. It has been over lately. But there are stocks that are going to perform well. Obviously, I guess if you own Janus, you're probably still happy about that. I still think that stock's a short, is because one man can have a big impact. It's like hiring your. It's like they hired Peyton Manning, brought him down to Janus.
Well, one of the things to keep in mind with that is the last article I read about Bill Gross's net worth was actually higher than what Janus was worth as far as their total capital prior to him coming on board. So he did bring a pretty hefty sway. The net inflows, I think, has already started to spike up, and the net worth, I think, exceeded $750 million just in his coming on board. So they're doing pretty well. But it's as you said last week, the short of the day, we're down 4.75% on that.
Bottom
stock.
line, this guy's a terrible trader. He's made every bad move he could do, and it's pretty bad when you have to run out of the firm that you founded, I guess, to make life work. But the bottom line is the bond market's a lot bigger than Bill Gross. The entire PIMCO fund, they trade in about 20 minutes every day. I mean, there's trillions and trillions of dollars of turnover every day in the bond market, so it's not really that big a deal. Anyway, to get off Bill Gross, he's getting enough press as it is, right? So, do we have anything else on? You got to go over did you go through weekly research and?
Not yet.
Okay.
So jumping over to weekly research, just to show you the state of some of the common foreign and diversified markets. You'll see that, in the case of commodities, just like we saw within the mutual fund side of things, where we sold off the last little bit of it. We don't own any of the classic ETFs at this point. And these little gray boxes over on the far right-hand side of this chart signify that they're flat positions. And you can see that there really are a lot of these little gray boxes across the board for the global market positions. There's a few places where we're still long, going down all the way to the bottom here on the major markets. These are the components that make up the global equity strategies. Again, the only position that we're seeing at this point is SPY. So if you have any type of portfolio that is diversified into these global positions, you're just not seeing those positions being held at this point. We're just not owning the bulk of the foreign space at this point. Lastly, jumping over to the globe at a glance, I think this shows you a pretty good indication as to where we're at right now on the global market. If we change this measure from year to date to this month, so this shows you the activity on these iShares ETFs month to date, you're seeing a lot of red. So as much as people talk about diversification across all these different markets, we're still seeing this take place as far as a lot of pullback in the global space in these different ETFs. And granted, some are more than others, but at this point, we're really starting to see a lot of the global markets start to turn over and roll over at this point. And that's it for the different dashboard components. The last thing I did want to touch upon under the commentary, we've talked before about, as we get towards the tops, the number of stocks that are participating with the average and exceeding it or not participating. And this S&P 500 pacing chart, I think, is a pretty good indication of that. You see that 56% of all these stocks that make up the S&P 500 are underperforming that overall benchmark. In other words, 56% of the stocks have less than 7% performance year to date, or they're going on to negative. There's only 43% of the stocks that make up that overall index that are keeping up with the average, the S&P 500, or they're exceeding it. So again, we're seeing fewer and fewer companies being able to pull the S&P higher, and the rest of those are beginning to show underperformance as well as losses on the year.
Just a quick comment there, Mitch. That was the opposite all the way through 2013. It was 60-40 the other side where they were outperforming. And so we're definitely seeing some rollover from the standpoint of the internal performance of the index. The other thing that I just wanted to bring up as this market continues to unfold, as I've talked about many times over the last couple of weeks, this is not 2008. So that's not what's going on here. What we're seeing is a rotation within these stocks and what's working, what's not working, and we're starting to see some more and more protection taken. And at some stage, like I said, maybe there's a trigger point. The markets get vulnerable when they get into this type of configuration where you see a few stocks being owned and they're under pressure. So you have a lack of trends. We're not the only ones doing quant work on this planet. And you see the lack of trends starting to emerge, and people start to move more and more money off the table. And I've always said that our real job is a cash flow analysis. If money's coming out of somewhere, where does it go? So sort of an allocation mentality, but sometimes there's nowhere to put money, and that's more or less where we're at right now. The bond market continues to be fairly risky from the standpoint of the configuration from that standpoint, and if unless you're European or from another country, then with a strong dollar, then that looks differently to you. So that may keep that market in check, but I don't think there's a lot of upside from the standpoint of appreciation, and there's really not very much yield from our perspective, unless you're in Frankfurt and you're looking at a 1% and change bond, and there's a big arbitrage here, and the U.S. dollar is strong. But other than that, that's not there. When you start to look at stocks, this is the thing I mentioned in commentary last night, is that you start to see a discounting of future expectations. Now, what we've seen in the markets going up to 2019 is an expectation looking forward that the economy is going to continue to do well. So let's say it continues to perform and there's very little activity from the standpoint of new buying going on. What you're going to see is this market sentiment continue to deteriorate, and ultimately you'll see some further declines start to come into the marketplace as far as more selling, and then it takes one little trigger when the markets are vulnerable like that to get all the selling going and a mass liquidation going. But we don't have the conditions for 2008 at the moment. Maybe there's some tipping point. There would have to be something we already don't know. There's not any big elements that I see right now, other than I talked about the other day. There are a lot of bubble type situations, and one thing is concerning me a lot is how the market's getting loaded up with all these new offerings with the Alibabas and all the banks, and I mean everybody's coming into market now. It's just crazy, everything that's coming right at this time. And so there's a lot of new supply coming to market, and one of the big stories, the backstory of this whole rally, is that corporations have been buying back their stocks. Well, now there's this new influx of money coming in. You start thinking, how many Alibabas, how many $50 billion trades can you do? And ultimately not way on the market. So I guess we'll leave it at that. Let me get over and let's go back to the charts here. And I can get everything kind of situated back to where we're going here. So we're seeing some selling. While I was distracted, we're back down 10 on the session, down at 72.30. Like I said, I think the ranges for the day have been established. If it takes out the low now, it would be pretty ugly, but I don't think anyone's going to be looking to sell this thing too aggressively with some of the reports and expectations. I believe there's also coming later this week on Thursday. So when we wake up Thursday morning, we've got the ECB and Mr. Mario Draghi talking about doing some kind of stimulus. I don't think anything they do matters, actually. The fact is that like I said, I would DVR Squawk Box Europe a few times and just watch some of that stuff maybe for half hour, an hour, especially around the European Open. They have some pretty interesting guests, and you get a different flavor for what's going on there, because the market participants that show up on that show aren't all mutual fund salesmen, and if they are, they're pretty straightforward as far as what they're talking about. They're not carrying some corporate line that some analysts in the back room said, don't say anything negative about this or that, and that seems to be scripted for the most part. And it's not that way, but the bottom line is that there is a lot of negativity. There's not much in Europe to look to go, wow, this is going to be great. Draghi will save us again. And I think the central banks have pretty much ran their cycle. there are people talking, and maybe this is the bottom, but there are people talking in Europe that this is there's another 10, 15 years of this stuff, that they don't see how Europe's going to get out of their own way. And when you start to look at some of these elements that are out there from in Europe, it's very difficult to see any positive growth coming out of any of the countries as far as that goes. And then with the Russian backdrop going, and there's still some interesting things that we might see out of Russia retaliating from a financial standpoint on some of the sanctions that they've had. That's an ongoing saga as well. So there's a lot of things. The world's pretty turbulent right now as far as that stuff goes. So we'll see how everything plays out at this time. So Mitch, what was it that you wanted to cover today? We wanted to go through.
Well, one of the things I thought it'd be good just to touch upon, I know we've talked about this quite a bit, was Apple. There's been some news lately out of the EU about some potential fines coming to Apple for how they operate business, and it will be interesting to see how the rules continue to change over in Europe as well as stateside when it comes to these tax inversions, as they've tried to shift their operations overseas as well as just generally operating a business overseas and what the tax rules are over there. Apple, of course, they released their phone. There was much ado about the bendable iPhone, although a lot of analysis have been done on that and have come out to say that it's much ado about nothing.
Yeah, especially when you saw that guy straining to bend it,
Right.
Yeah, I've never done that to one of my phones. I don't know. I never sit there and see if it'll bend. So anyway, let's take a look at this stock real quick. And from a technical standpoint, we've come down. The PPMs here are still pretty positive, and we still have a long position on this stock, and we're likely to keep that going for a while. The fast average is 99.50, which is right pretty much where we are trading right now. We've got a plus 0.64 on the 10-week moving average, which tells me there's some pretty good support right here at the 99.50 level. Below that, we're 95.53 and then all the way down to 86. And we're plus 0.82 on PPM2. And this is not likely for this stock to break down very much, actually. In fact, if you look at the PPMs off here to the right, the PPM1 is attempting to turn back up and start to expand again in spite of the minus 0.75% on the markets today. So we'll see how this plays out. I suspect that this will go into a sideways range, and depending on what happens, the bottom line is, with Apple being such a huge weighting in the markets, S&P and NASDAQ, you're going to see if this is going to be stable, then that's also going to tell you a little bit about how much downside there is in the markets, at least for the moment. Now, as I've talked about before, each time a new increment goes by, so this is a weekly graph we're looking at, each time there's a new bar, if you're starting to see a dissipation of momentum, then you're going to see that continue to decline. Then you're going to see some vulnerability to the market to move down to some of these other levels, maybe getting down to 95 or maybe even 86 level. But at the moment, that doesn't look very likely. So that may be just the Apple component may be enough to hold the markets from going too much lower in this pattern at this time. This is most likely going to be the case from this standpoint. Really quick here, I'm going to just punch in, look at the minutia here, and we'll bring up a 60-minute graph on Apple here, and you can see that momentum is actually turning up and it's stabilized from Friday's move, and now we're seeing some further stabilization here. But there is some downward objectives, which is interesting here on this very short-term chart. Down here is a objective for the market, for this stock to move down to 95.65 to 93.71, but the PPMs would suggest that that's probably not going to be the case, that this is going to firm up. So keep the show rolling here, Mitch.
All right. One of the other stocks that we saw in the S&P 500 that had a sell this week is EA, Electronic Arts. This one has done fairly well. They're a video game manufacturer, and they've released a number of titles earlier this year. Seen some pretty nice profits on it. However, we do have a fresh sell on this signal, or on the stock today.
Yeah, and you can see it's broken down through the moving averages. The PPM 1, let me get it up on the screen here. PPM 1 is currently, let me get down there. PPM 1 is minus 0.33 and minus 1.6, and then a plus 1.6 on PPM 3. But we are below all three averages. We're negative. We've actually got trend mode on a short-term basis, and this is once this pattern broke down on Friday, it looks like, and I have a daily chart here, by the way. So let me switch over to a weekly so we get apples and apples here. So here, much different position here. You do have, interesting enough, at PPM 2 is at 0.99, but I want you to look at this indicator over here on the right. You'll see that it's breaking through its first and second derivatives. All these indicators are down. The PPM 1 is minus 0.66, which is a pretty sharp downtrend. It's at 36.34. The PPM 2 is, or I'm sorry, the 21-week moving average is 36.13. So this is a collision going to happen. We're gonna slice through these moving averages here in this pattern, which would suggest that this thing is rolling over, and we're probably going to see us get down to around the 32 level, at least initially, which would be the 40-period moving average, and that would be equal to the 200-week moving average. So often what happens with VPM when it's starting to get a sell signal like this, you'll see the rollover happen, and momentum can trigger it. Also, price change in these moving average patterns can trigger a sell, and this has been, what kind of profit did we generate on this last trade?
Let me double check. Last I looked, it was around 34-35%. Let me pull that figure up.
So what's going to happen on these type of situations when you get this? This is taking a profit. We'll see. I don't think it goes much below 32. That's maybe, what is that, 10% roughly on the downtrend, and then see if it can stabilize around that 40. And if it does, then we can see some further consolidation, maybe another rally to the upside. There were price objectives of 45 to 52 on the Fibonacci indicator. If you look over on the right, let me draw a couple lines here. You can see this stuff. So you can see right up here, 45 to the 52.40 range is the expectation. But with this thing breaking down now, once this low is taken out, which is going to be around the 32 level, if that's taken out, then that's going to negate the upside. Until that happens, this pattern will stay intact. What VPM's measuring here is this pattern right here, and until that low is taken out, it's going to remain valid from a pattern standpoint. Doesn't mean it's going to go there. Just the pattern has to be broken before this calculation over here will stop occurring. And it looks like it's on track to do that. But once that happens, then if I clear out some of this stuff here, see if I can clear that out. There we go. What you'll get is you'll have this pattern set up, and whether it can go here or whether it's going to break this level and go down is what we don't know. But for now, the whole idea is that the trend has been broken. So VPM is going to take that 33%, throw it into the bank, and wait for the next trade and next configuration. Next, Mitch.
All right, next up is Oracle. Of course, they made news this last week or so when one of the big names over there, the founders, is
Larry Ellison.
Yeah, thank you. I was blanking on the name.
Yeah,
was going to be stepping down.
My
ticker
favorite.
On that is,
go ahead.
ticker on that is ORCL.
Yeah, I got it. My favorite was, there was a book I saw back in the 90s, and it said, what's the difference between Larry Ellison and God? And it said, God doesn't think he's Larry Ellison. So Larry's always been an egomaniac. He's always pushed the things to the edge, and he's stepping out of the way to a point. I believe he's still on chairman of the board, but he is stepping down. Another billionaire that's, you have to wonder why he shows up for work. I don't know. I'm going to have a hard time when I get my first billion. You guys probably won't see me that day. Anyway, but the bottom line from Oracle, we're seeing a continuation of sell. I suspect we've been out of this for a little bit here, Mitch.
Actually, we were just getting a sell on it today.
Oh, today. Okay, and so we had a buy, and then looks like probably a small loss or something coming out, right?
Yeah, let me take a look. Looks like we're selling with a 2.635% profit.
Oh, okay. So it bought it back a little ways. Okay.
Yeah, this is on the 3.2.
All right, that's why.
So we've been in it for a little while.
Yeah, so it was way back in this pattern over here.
Yeah, back in December of last year.
Yeah, there you go. So yeah, so the PPMs -2.6, -2.2, and a +1.6 PPM 1, 2, and 3, and this is pretty typical as it breaks through these numbers. We're seeing this roll over, and there's some huge acceleration on PPM 2. You can see this indicator where my cursor is over here, and it's plummeting down pretty sharply here. It's down, like I said, -0.22, so it's right on the verge of being in a trend mode. What can happen with these patterns, just draw this out real quick, make this an educational moment here, is when you see these patterns like this is very similar to what we had in EA, as they will go down to a point and then you'll start to rally back. Then it depends on what these moving averages are doing when it rallies back, whether or not we get further decline. Maybe we're heading back to these levels here. It's hard to tell how this thing ends up unfolding, but for now the trend has definitely been broken. You got two of the main indicators down. You also have the PPMs negative, and then you've got the price change under the moving averages. They're breaking down as well.
All right, shifting gears, I thought it'd be good to talk about some ETFs. One of the ones I wanted to pick on today is EEM, and talk about the breakdown that's taking place in that space. Of course, we're out of that position. We sold the 1.2 weekly position back on the 22nd at 43.08, and for the portfolios that have it on a daily basis, we'd actually sold it higher back at 44.1. Yeah. So we've been out of this for a little while now, and we're seeing that take collapse further to go down.
So the EEM is positioned in the global equity strategies, and Global Equity 4, it's actually set on a daily model. It's the only one of the strategies in the global series that has a daily model, and it's added a lot of value. It was able to do some magical things back in 2008, but more specifically, this particular instrument, if I bring it up on a daily basis here on the screen, you'll see there's some pretty good volatility. So there's opportunities, shorter term opportunities. So from a tax efficiency standpoint, maybe you pay a little bit more on some of these trades, but from a profitability standpoint, it's definitely the right thing to do. And you can see the overall returns when you go to the fact sheets or go to the Global Equity 4 portfolio to see how this thing is unfolding. You can see this volatility is just, this decline is pretty substantial. What we're seeing here, though, we got -3.2, -3.33 on PPM2. PPM3 is 0.089. So it's flattened out. Typically what we'll see the market start to form some sort of bottom here, and we can go and break this down a step lower and go into the hourly graph. You can see this thing has just been gapping lower in the last several days, and it gapped again. So we will probably move back into this level and then see the market set up some kind of low. And going back to the daily graph, then we'll see there's building an opportunity for the market to rally back from maybe 41 back to 45, maybe 46, all of a sudden that's potentially a 10% gain in the stock. And if we can capture 6 or 8% of that again, then that's good. I think the allocation factor, Mitch, on that Global Equity 4 is probably close to 30%.
Yeah, I believe it's 33%.
Yeah, so when you do get this trade, if you make 10%, you're gonna make 3% for your portfolio if the trade works. When it comes back on, if there's another percent gain, like it looks like it can buy it at 41, so 45, 46 range, going back into these moving averages. That's why that trade works so well. It's got a great ER ratio. It trades really well, and that's why we've suggested over the last almost 3 years now to utilize Global Equity 4 as your global equity strategy. And typically what happens, and the reason why that adds some value, I'm just kind of can't get out of this loop here. The reason why that works is because it will trigger some reallocation sells sometimes. So when the markets are very bullish, it will actually cause a rebalancing. Even though it's making these smaller trades, it actually triggers some other positive things from a portfolio standpoint. So there's two elements. I always try to point out that it's not the virtual stock trader, it's the virtual portfolio manager that we run. And so there's portfolio dynamics that you have to understand, as well as the individual trades that are going on and what triggers both. This will trigger a rebalancing type trade along with other elements where it will also get you into cash and a protect mode quicker because of that response. So we've seen a pretty good, I think in 2008 it was actually positive on the year by like 2%, and it had everything to do with that particular item in the market. So it was able to do a really good job. So in the event that we got in a very negative mode again, this would be probably the one symbol that could generate positive returns in even a down market, as it hit bottoms and rallied and then got back out, since the whole strategy is actually a long only strategy. You're going to need those type of things, and you'll see a lot of more positive attributes out of that. So if you're not using Global Equity 4, you should take a look at it. There's fact sheets, everything in the downloads area that you can look at to authenticate and to confirm what I just told you. So what do you got next? One last one for the end of the show here, man.
One last one. Well, I thought it'd be fun to take a look at Russia. So let's pull up the ticker ERUS. And we actually are long this position currently, one of the few international positions we're long. However, we are at a loss at it on this of 7.945%.
Yeah, it must be a 3-2 trade, right?
It's actually 1-2 weekly.
1-2 weekly, okay. So a couple things that are there on this particular chart, while it's drifted lower, we're seeing PPMs pretty negative though, minus 0.82, but we're about to break first derivative plus 0.22 on the PPM2. PPM3 is minus 0.45, so you got a very mixed scenario here, and it's going to take getting back above these moving averages for this market to really get moving. And I guess maybe, didn't they just strike a deal, I think, with the Ukraine on the natural gas? I believe that was something that happened on Friday. There's some kind of treaty or something that they have going so that natural gas can continue to flow to Europe as the chilly weather starts to come on. And so maybe that'll be enough to trigger it. It really doesn't show up here. We're down 2.67% right now, maybe because of the issues that their best friends are having, which is China right now. Maybe that's why we're seeing some downside on this particular market at this time. But the PPM1 is negative, but trying to make a turnaround, which suggests that we should see some stabilization somewhere around this level here. There are no downside targets, but there are upside targets of 22 to 26. So we have about a minute to go. I'll go back and do my usual switch around, and one of the things I haven't looked at is the international spread chart that I usually talk about. This did spike up yet last week. We're seeing it flatten today, so we're not seeing the the spread turning around yet. So this is still the point I'm looking for that to turn around. If we look at, I want to go to the futures analysis. You can see that early this morning, the 5-minute graph had a cycle come in right in the range where we saw a bounce. We're likely to see maybe another top if we rally back in and try to rally toward the end of the session. It looks like this thing is, like I said, the range for the day is about 80, in probably a 90% probability that it's in play right now. So it's not going to do anything outside of that range, I would doubt. And like I said, the numbers so far today, and I didn't mention one number really quickly, and I'm going to run over again today, but the S1 on a monthly basis on September is 1967.85. We printed 64 this morning, so we have done R1, S1 on a monthly basis, and it looks like I said, 1978.50. Tomorrow's close is going to be big. I'll mention that in commentary. We close below that on a monthly basis. That's going to make it an extra negative. Anything under 2003 is going to be negative as we close lower, but it doesn't necessarily send the same message that a close below 78.50 would. So anyway, folks, this will be it until Friday. We'll recap the markets. We'll have unemployment and all kinds of fun things to talk about on Friday. So have a great day. We'll talk to you on Friday morning. Thanks again.